Joining us now is Nick Wall, Portfolio Manager at Merian Global Investors. Nick, great to have you with us. So we see the pound surge yesterday. It's steady now on optimism again. We, of course, as this chart shows, which is the first thing I'm going to show you, is that the pound is so sensitive to every single headline we've been getting out of Brexit. How likely is it really that we're going to see this pass in Parliament? Is that your base case?
I think the base case for the market is certainly that she's going to struggle to get the votes. And I think what you've seen yesterday from the action from Labour MPs and from Tory rebels is that it will be very difficult for her. We actually think, though, that there's more chance of this deal passing, maybe not at the first attempt, but maybe the second, than the market currently expects. Now, I think the reason for this is, at the moment, the market's mindset is very much on one where they look at Theresa May's plan, MPs look at Theresa May's plan, and it looks bad against full EU membership, or it looks bad against the Brexiteers' kind of dream of a global Britain. So both are going to be kind of anti this withdrawal agreement. I think once we get closer to a hard Brexit, and once the kind of no deal becomes more a reality and you start to see the real world implications, I think then it goes between looking at this withdrawal agreement against a hard Brexit scenario rather than the current situation. And therefore, I think that focuses people's minds. I think you saw, you had Hilary Benn on Bloomberg yesterday, and he said he doesn't want to see a second referendum. He doesn't want to see a hard Brexit, but he would vote through a proposal if it softened the Brexit a little bit. I think more and more MPs are going to get to that point in time and want to move on with Brexit, want to kind of deal with the other issues that are affecting the UK economy, and may end up voting it through.
So you don't think that markets are in any way underpricing the downside risks then?
I don't think they are. I think there's no parliamentary majority for hard Brexit. I still think that's the case, and I think if it did appear that we were heading towards that scenario, it's not really a vote winner. I mean, it would be it would be very visible damage to the UK economy. It would damage the Tories for years, and I don't think anyone will eventually want to get there.
What about Theresa May being ousted, the prospect of a second referendum, anything like that? Are those just very indistinct possibilities at the moment?
I mean, Theresa May is, trying to forecast her downfall is a kind of fool's errand at the moment. She's actually seems to be getting stronger and stronger as these negotiations go on, and she's already seen overseen one Tory rebellion, and she came through that, and actually she came out probably stronger than she was before. So I think Theresa May will be around at least for a couple of votes through Parliament. A second referendum, I think there is a growing campaign for it, but I think that would be almost a last resort for a lot of people.
Right. So at Merian and as a portfolio manager, are you allocating based on a particular outcome that you have a strong conviction will happen, or are you sort of just going about your business and just letting the noise play out?
Well, in our funds, we are, volatility has gone up, and the outcomes are quite binary. So we do have exposure. We are long sterling, and we do have a short gilt position on. But I wouldn't say they're necessarily overly aggressive because of the binary nature and the potential big swings in these two asset classes in either scenario, whether it's a hard Brexit, which we don't expect, or whether it's a kind of withdrawal agreement. Now,
long sterling I get, but why short gilts? Because some say that you'd actually see, well, even Mark Carney himself has said that the possibility of a rate hike might be higher on no deal. But if you're expecting a deal to get passed, you still have a short gilt because of the Bank of England, or a different reason?
Yeah, I think you'll see a lot more rate hikes priced in if you get a withdrawal agreement rather than a no deal.
Right.
I mean, I think politics might catch up with the Bank of England if we do get a no deal, because economic forecasts will be revised down rapidly, and the kind of inflation effect from a weaker sterling will be quite transitory. Whereas if you get a withdrawal agreement, I'd expect to see some investment come back and some business confidence return, as well as consumer confidence, and then I think you see more hikes priced in. You've also seen, whenever you get bad Brexit news, you see gilts rally, and as people reallocate out of UK risk assets and into a perceived safe haven such as gilts, I think you see a reallocation back into riskier assets within the UK market, out of gilts and into UK equities.